Hello, good evening. We will continue our discussion on economic value added. One important point which we will try to focus our attention today is on how different is economic value added from the normal conventional accounting returns like return on investment. We know that economic value added is the excess of net operating profit over the cost of capital, and the cost of capital is computed by multiplying weighted average cost of capital into capital employed. Now let us see what is ROI or return on investment. To start with, return on investment is an accounting profit and accounting profitability. It establishes relationship between accounting profit and accounting investment. But ROI is a generic term. So to understand how ROI differs from EVA, we can say that ROI can be classified into three broad categories: return on net worth, return on capital employed, or return on total assets. So return on net worth is a profit after tax divided by net worth. Return on capital employed is profit before interest and tax divided by capital employed, and return on total asset is also profit before interest and tax divided by total assets. But let us take all of them together and call them as ROI. So ROI is an accounting profit divided by the accounting investment, whereas EVA makes an adjustments for accounting anomalies and also brings in the weighted average cost of capital, which is not there in an accounting or in a financial statement. So that means EVA recognizes the weighted average cost of capital, or in other words, EVA recognizes the cost of equity, whereas ROI, any of these versions, will not recognize the cost of equity. So one of the differences between EVA and ROI is the cost of equity. The other one, that ROI, since it is based on accounting profit, so the normal accounting assumptions, which we call generally accepted accounting principles, are definitely recognized while computing ROI. Whereas we also saw that in EVA calculation, we try to deviate from this accounting assumption. For example, the goodwill is not to be amortized, R&D is not to be amortized, lease is always to be shown as a finance lease, not an operating lease, depreciation should be shown as an economic depreciation. So these are the accounting adjustments required to convert an accounting profit into the economic profit or NOPAT. In the same way, the capital employed also differs. While computing EVA, we take economic capital employed. That means the capital employed for EVA calculation is the total assets minus the non-interest bearing liabilities. Or in other words, it is the total sources minus non-interest bearing liabilities. Or in other words, it is capital plus reserves plus long-term liabilities plus interest bearing current liabilities. So what are these non-interest bearing liabilities? For example, creditors, outstanding expenses. These items are sources, but there is no explicit interest on that. So for EVA calculation, we say that these are not having economic cost. But for return on capital employed, we take all the long-term sources. In other words, therefore return on capital employed, total assets minus the current liabilities. Or in other words, capital employed for accounting is capital plus reserves plus the long-term liabilities or long-term loans or bonds or debenture. So as a result, both the numerator PAT and the denominator investments are purely based on the accounting assumption, whereas EVA, you make an adjustments for accounting anomalies or accounting assumptions, and also for computing the capital employed, we make the adjustments. And these adjustments, as we have discussed in one of our sessions in the past, is actually called the accounting adjustments to convert accounting profits into economic profits, and these are also given a name called the equity equivalence. So to summarize, if I say that return on investment is a relationship between accounting profit and accounting investment, whereas EVA is a return for the shareholders after making adjustment for accounting anomalies and also recognizing the cost of equity. As we know, cost of equity is not there in the financial statement. So in principle, both are the variations of profits, but one makes an adjustments for accounting adjustments, makes an adjustment for the cost of equity, other purely depends on the accounting. But as an analyst, as an user, I would like to take both EVA and ROI and understand the profit making ability, profit distributing ability and profit generating ability. Thank you very much.